Hello guys. Welcome to PRS. My name is Tshireletso and I'll be your educator today. So today we are gonna do basically a walkthrough of cost of capital. So today I'm gonna be focused on cost of capital and sources of finance. So cost of capital and sources of finance. So before we start, I just wanted to go through this approach. So this is basically our approach, PRS approach of learning. So basically, what it is firstly, to understand the topic, you have to firstly understand why you do it, and then what you're doing, right? And then how to apply it, right? So how to apply it is now basically going to give you a framework of how actually you're going to do that thing, or how I'm giving you basically steps of how to apply that thing in a question. So from step 1 up to maybe step 4, step 5 of how to apply this, right? So now I'm going to start with why we are doing this thing, right? Because it's very important, especially for a topic like cost of capital. Once you understand cost of capital, then you won't ever have a problem with it. It becomes a problem when you don't understand why you're doing it, right? So now I'm going to start with this component, this Y component. So this Y component is illustrated by two things, by this objective drive and perspective drive. So I'm going to start with it. So firstly, we have our objective driver, right? And what is this objective driver? So it's basically what is finance, right? So the objective of the financial manager is to maximize shareholders' wealth, right? So that's what we know. That's what we know. So the goal or the objective of the financial manager is to maximize shareholders' wealth, right? So it's very important to understand this and why I'm stating it now. So what does this mean, right? Shareholders will firstly give the financial manager assets, right? So the shareholders will give the financial manager assets, right? And those assets can be in the form of money, or it can be any type of resource, right? It can be money or it can be a business, right? But in most cases, it's a business. So a shareholder invests in a business and then hires a financial manager, right? The financial manager is on an executive role, right? So someone like a CEO, CFO, right? So that's a financial manager, right? And what is this guy's duty? This guy's duty is to take these assets, right? And then to add value to these assets. Do you understand? This arrow here indicates value. So what he's doing is this guy is adding value to these assets and making these assets bigger, basically, right? So he's going to take these assets and then go to the market, create a return using these assets. And then what's going to happen? These returns are going to be in the form of, it can be in the form of money, but in most cases, returns are in the form of money, right? Because you'll be selling whatever you'll be selling, and then customers will be paying, right? So your asset base will increase because bank is assets, right? So your assets will increase, right? And then what's that asset base made out of, right? So firstly, these assets that you have, right, a portion of it is attributable to liability holders, right? So you have to pay your liabilities, right? So that's the first thing you have to do with your returns. You have to firstly pay these liability holders, right? And then what do you have to do after? You have to also pay dividends to the shareholders, right? So you have to pay the dividends to the shareholders. And even if you don't pay dividends to the shareholders are going to want some sort of return, right? Even though that return you're not paying them, they're going to expect the business to generate some sort of return, right? And that's part of equity, right? Now, if the business generates a return, that's greater than the liabilities and what the equity wants, right? Then you've created wealth, right? That's growth. Shareholders' wealth, that's growth. And that's the goal of the financial manager, right? To create wealth. So what I'm saying is, let me give you an example, right? Gonna take these assets, create profit, right? What's the first thing you're gonna do with this profit? You're gonna firstly pay your liabilities, right? And then after paying your liabilities, right, you're gonna take a portion of it and pay your equity holders, right? You're gonna pay them dividends. And then the money that's left in the entity, you're gonna use to buy other assets, right, and grow your business. And that's shareholders' wealth, right? And then now what are these two diagrams? So basically this one illustrates that um, to create this value, right? To create value, the financial manager has to take decisions, right? And these decisions are the ones that ensures these returns, right? Take decisions. However, he has to also consider the risk involved or risk associated with each decision that he takes, right? And the thing is, the reason why I'm giving you this diagram, you'll see in finance, they like using words like return, risks, planning, evaluation, but tying it up, like tying it all together is very important. Knowing where it fits is all together, right? So this is basically, this creates value, right? You take a decision, that decision has some risk associated to it. And then if you consider those risks, then definitely you'll get your return or a high return, right? If you consider the risks. And then now we go to this is the finance process, right? I call it the finance process. So every topic in finance, in financial management, whether we're doing costing or we're doing finance, so this time you're doing finance, right? So every topic in finance, you can classify in one of these three categories, right? So firstly, like I told you, this financial manager has to take decisions, right, that bring value to the company, right? So firstly, with this finance process, he can be firstly at the planning stage, right? So when he's at the planning stage, he's planning for things, right? So he has to consider risks associated with what he's deciding in the planning phase, right? And you'll see even what you're doing right now, like cost of capital, we're doing it on the planning stage, right? We're still on the planning stage. Why? Because you'll see when you're doing cost of capital, you have to decide which source of finance you're going to use, right? And for if you're still deciding which source of finance you're going to use, you see that you're still planning on which source of finance you're going to use, right? And then the second type of finance, so finance topics we do is evaluation, right? So that's things like financial statement analysis, right? Or financial statement analysis, right? Or that topic that you just did in unit 3, the valuations topic, right? You do valuations. Why do you do valuations? To get information from basically that scenario. So you do valuations to get information. So the financial manager does these valuations to get information. As you can see, for instance, if you do, let's say, the valuations topics, right? Valuation topic. The reason why you do valuation, right, is to see what's the value of that entity, right? Either using maybe the free cash flow model or that those other models, right? However, you're still evaluating that company. You're still deciding. So you're still deriving information from it. However, you're not deciding. Do you see? Planning, you're already deciding here that I'm going to take this thing. Here, you just want information. And then control stage is just functions of the entity that require management, right? So for instance, things like inventory, right? So inventory, for instance, the management of inventory or stock control, right? That's not like an investment decision, right? You're not deciding whether you're going to invest on something or not. It's just how are we going to manage now our inventory, right? So that's finance in a nutshell, right? So you'll see every time I do finance here in PRS, I'll link it to this diagram so that you know how does this thing actually maximize shareholders' wealth, right? So we can continue. Like I said, cost of capital is here, right? So now we are doing cost of capital, right? So now, why do we do cost of capital? Why do we do cost of capital? So the reason why we look at cost of capital, right, is so that the financial manager is able to firstly value, right, the cost. Number one, you have to know how much is the cost, right? And sometimes calculating this cost is not as simple as just seeing a percentage, right? We have to really go deep inside that contract and see the substance basically of what this thing actually costs us, right? And then the other reason we're doing it is so that now that you know how to value these costs, right, you can be able to make better decisions, right? Better decisions in terms of which source of finance must you take, right? Or capital structure must you take, right? And then that's very important because like I showed you here in this diagram over here, the previous diagram, like I showed you here in the previous diagram, right? Don't forget that the shareholder, right, is here. So this box here, do you see this part? Retained earnings and equity, they belong to who? To shareholders, right? Do you see, like I said, the more shareholders you have, the more of these dividends you're gonna have to give, right? And the more liabilities you have, the more of these, basically the interest you're gonna have to pay, right, to liability holders. So do you see that the more you have these sources of financing, right, the more these returns are gonna be diluted, and as a result, the entity in essence will not like grow, right? So what's the goal of this thing is to lower this cost, these costs of capital, right? Because they do affect the growth of the company, the overall growth of the company. And what is our objective is to maximize shareholders wealth. So we have to know what is the cost of these funding options, right? So these sources of finance, right? And that's what we do when you do cost of capital, right? So you'll see sometimes I'll use these words interchangeably. So capital and finance, right? Because it's the same thing. So cost of finance or cost of capital is the same, doing about the same thing. Okay, let's move on. So now let's look at what this thing is. So what is cost of capital? So we do cost of capital. Why do we do it? We do it to arrange the capital according to the capital structure that's in our strategy, right? So in a strategy just means that the capital structure that's decided, right, by the overall like management, by the executive, and pay the lowest cost in financing. So we are still here. So this thing of target structure, I'll come back to it when you're talking about WACC. So now you're not yet dealing with WACC, but I will talk about target capital structure when you're dealing with WACC. So now I want to talk about this low cost, right? So let's read this thing. So it says a financial manager. So if a financial manager has an investment opportunity, right, he or she has to determine whether the opportunity is feasible, right? So feasible means he has to check whether this investment opportunity that he has, like he can take it, right? With the use of the NPV or the IRR, right? So there's many ways to determine whether investment opportunity is good, not only with NPV or IRR, but these are the top ones, right? These are the ones that are used in the industry, right? Because these ones, they give you the it gives you like a much better reflection, right, of what's going on. So let's see let's see what will happen. So first, you're going to have this investment opportunity, right? So like I told you here, right, you have this opportunity now to invest. Why do you have this investment opportunity? You want returns, you want to increase this asset base, right? So that's the first thing you're going to do. Now, with this, you're going to consider this investment decision. And how do you consider this investment decision? You're going to firstly, let's look at this NPV. How do you do NPV, right? You project basically your cash flows, right? The expected cash flows that you expect to receive with this opportunity, right? This investment opportunity, you project them, right? And then what do? You have to calculate the net present value after you project them. So for year one, for year two. So you know when you're doing like something like the capital budget, right? So you do like the NPV, right? Then what do? We have to discount that thing, right? And what do we discount it with in most cases? We discount it with WACC, right? Now, I will come back to WACC, but what I want to tell you now is that we discount that thing with the cost of capital. And why do we discount it with the cost of capital? That's very important to know. Why do we discount it with the cost of capital? Why do we use a discount rate to discount those cash flows? Easy. That's because, like I told you here, when you go back here, right, that this guy is going to take these assets, right? And these assets, do not forget that it's the shareholders' assets, and they also took maybe some liabilities to increase this asset base, right? So what's going to happen is that this this the financial manager, right, is going to firstly project what his returns are gonna be, right, in future. And why do we discount it? And what is discounting? What is this thing really? Ne? What we are doing is using that percentage of the cost of capital or the work when you're doing NPV, right? What we are doing there is basically paying them throughout those years, right? Paying them throughout those years. So if the NPV is positive, it shows that what you can do is this investment opportunity is enough, ne? Is enough so much that you can pay these people, right? And even have, right, have some growth, right? So if it's positive, you know that there is some growth, right? And you can pay these people. That's why you use the discount rate, because the discount rate has the compilation of these people's costs, right? The work, right? So that's why the NPV, when it's positive, we take the investment decision. Why? Because we are maximizing shareholders' wealth. What if, let's say, the NPV was zero? Then what does it mean? It means that this investment opportunity actually pays these people in full, but there's no growth after, right, with this investment opportunity. And then if it's negative, it means that it can't even pay these equity providers, right? And if it cannot pay these equity if it cannot pay these equity providers, then you cannot take that investment decision, right? It's not feasible, right? So that's what it means when they say feasible, right? Because we have these cash flows now. Can we pay these people paying us finance, giving us finance, right? That's the financing decision. So now we can move on. What's straight up with the like cost of capital straight. So how do you do cost of capital, right? So there are many different types of sources of finance, and it depends on the question that they will ask you, right? There are various questions that they can ask you, right? They can ask you to calculate the cost of that particular finance, right? Or ask you to calculate maybe the total work, right? Those are the two types of questions they can ask you based on this topic, right? So firstly, I'm going to deal with when they ask you to calculate the cost of that particular item, right? So not the work. After, I'll deal with the work. So now the cost of each source of finance, right, is expressed in terms of a percentage. As you can see, like most of the times, costs are presented in terms of percentage, like, right, like it's 14%, 18%, those types. And then like even for loans, like maybe this loan is 8%, right? So it's expressed in percentage in most cases. Or sometimes they ask you an amount, right? Now, in places where they ask you an amount, they will tell you straight what is the cost of this particular finance, but they will tell you in rands. If they didn't tell you in rands or in like give us the amount, then use a percentage, right? Because that's what they mean, right? And then, so what is it really? And what is this cost, right? Like I said, is the return that each source of finance wants for giving the entity capital, right? So it's what those people want. It's what the equity holders want or the liability holders want in the end, right? That's do not forget, although we invest in a like in an investment, we invest our money in like maybe an investment opportunity, right? These equity holders, right, and liability holders, so that these banks and investors are actually investing in us, so they're expecting a return from us, right? So this is only about perspective, right? So the return that they expect from us is actually the cost of capital, right? Then there are different models used to determine the cost of capital finance, and you'll see what I mean when I say models, right? Used to determine the cost of finance, and one must motivate the use of one model over the other, right? So to determine some sources of finance, you can use two models, right? Mare, you have to firstly explain why you're using this model over the other, right? Because they are both there to calculate the cost of that particular finance. Then, yeah, can now start now with the detail. So we're starting with the first source of finance. So that's ordinary equity, right? So in most cases, it's just called the cost of equity, right? The reason why I call it ordinary equity, it's because equity has like they are like other instruments of equity, right? Like for instance, preference shares. Preference shares is also equity, right? However, this is not talking about preference shares. It's talking about ordinary equity. Please note that it's talking about ordinary equity. So you're talking about shares here. You're talking about shares and things like so other equity, other forms of equity. So things like if you see revaluation surplus or retained earnings, all of those things that are not instruments, then that thing is, it may be a source of finance, but there's no way they're going to ask you to calculate the cost of that equity. Why? Because the cost of other sources of equity like retained earnings, revaluation surplus, and all of those ones, right? Obviously, other than ordinary equity and preference shares. So other than ordinary equity and preference shares, all those other types of equity, the cost of it is zero, right? Because think about it, it's the equity that you already have, right? So to use that equity, it costs the entity nothing, right? So that's its cost, right? So if they can ever ask you to, maybe they say, what's the cost of the retained earnings, right? Zero, right? Because like I said, cost is what it's the return, right? That source wants, right? So just imagine, like with retained earnings, we are the ones using it. So who wants the return? We do, right? So there's no cost to us, right? We can continue. So now I'm going to so with equity, let me go back here. So with equity, right, there are two forms of equity. It's preference shares and ordinary shares, right? And then with loans, for the cost of capital for liabilities, but I'll come back to it. Let's just finish the equity, right? So ordinary equity, there are two models, right? The first model is the Gordon's dividend growth model. Now, this is what I meant here, right? That if if there's more than one model, then you have to motivate the use of one model over the other, right? For determining cost of equity, there are two models you can use. So two methods basically you can use, right? And it depends basically on some factors that I'm going to talk about now, right? However, in terms of like determining the cost of finance, ordinary equity is the cost of equity, right? It's the only source of finance where you have to motivate whether I'm going to use this model or another model. Whereas like other sources of finance, you don't need to determine that there's one formula for each cost, right? It's only the cost of equity that has more than one formula, right? And you have to obviously motivate why you're using this formula over the other, right? Sometimes it's as easy as, or most of the times it is as easy as they just give you information relating to one formula, then you know what formula to use immediately, right? But if you have to choose, this is how you choose. So with the Gordon's dividend growth model, what do you have to know? It's only applicable only to firms that pay dividends, right? So just imagine if the company doesn't pay dividends, this model is not really applicable to them, right? And then even for those companies that pay dividends, right, there's a key assumption, and you will see with this formula that the dividend grows at a constant rate, right? That's so if they can ask you also disadvantages or advantages, this is what you use, right? That the disadvantage of this model is that it assumes that the dividend will grow at a constant rate, right? Because it's using its dividend to determine this thing, right? And then here, for the dividend growth model, again, that the estimated cost of equity is very sensitive to the growth rate. Okay, it has to be very sensitive to the growth rate. So this one, it's good for what? For growing companies. So if a company is still in its growing phase, right, it issues dividends, then most probably you can use this model, right? But you'll see that the choosing part is not, it's not the issue, right? And it doesn't explicitly consider risk. So the reason why I also put on 3 points is because this is not really that important. The important part is, do you know how to really use this formula, right? And let's come to this formula. So this formula, it says PO is equals to D1 divided by RE minus G, right? So what is PO? PO is the value of the share, right? The value of the equity, right? Because do not forget, it's either calculating, when you're saying cost of equity, it's cost of ordinary shares or cost of preference shares. Here we are dealing with cost of equity, so it's cost of ordinary shares, right? So this PO is the market price, right? Or the value of the shares, right? At that point, right? At that point you are calculating. So this is the market value of those shares. That's PO. So that's the value of those shares, right? And the value of these shares, right? Do you see they say it's equal to what? D1. And what is D1? D1 is next year's dividend. Very important. Please note this. D1 is next year's dividend, right? This is very important to note, because why? They may give you this year's dividend, right? Do not forget, if they give you this year's dividend, right, then you're gonna have to take this year's dividend and then multiply it with the growth, meaning add the growth in that year's dividend to get next year's dividend, right? Because when you're supposed to use this formula, so if you're supposed to use this formula, right, they're gonna give you this growth, right? And then let's say they say the dividend is this year's dividend, right? You know that the entity is supposed to grow at this rate, so meaning even the dividends are supposed to grow at that rate, right? So if they give you the dividend, right, make sure that it's next year's dividend. If it's not next year's dividend, take that current, it will be most probably the current year's dividend, take that current year's dividend, right, and multiply it by the growth, right? So add the growth. So let's say the growth maybe was 5%. You're going to take whatever the dividend is, the current year dividend is, multiplied by 105%, right? Basically increasing that dividend, right? And that's basically how it's done. The G, it's the growth. They will tell you what the growth is, right? And the RE is the what? Expected return. For who? For the ordinary shareholders, right? And like I told you here, the return for the ordinary shareholders is the return for the ordinary shareholders, which is the source of finance, right? Is a what? Is a cost to us, right? So do you see here, this RE is actually what? It's the cost of equity. So this RE is the cost of equity. So everywhere where you're gonna see this RE, expected return, right? Just know that that's the cost, right? That's the cost. Like I told you, what's the cost for us? It's the return. It's their return. Why? Because they're investing in us, right? So that's their cost, the expected return. So in the question, most probably they're gonna give you the market price of the share, right? The dividends of the share, right? And then they're gonna give you the growth. And then what you're gonna have to do is calculate this, basically this missing figure, right? So that's how you do it using the dividend, Gordon's dividend growth model. So sometimes they call it Gordon's dividend growth model. Sometimes it's the dividend growth model. But you'll see it's the same formula basically. Now we can continue. So number two, I don't know, in your slides, it's called the SML approach, right? So in your unit, they call it SML approach. However, we know it more as the CAPM approach, right? So CAPM method. So we call it like CAPM, right? So what is CAPM, right? So CAPM is another method, right? So it's another formula, right? Other than the Gordon's dividend growth model to calculate what? Still ordinary shares, ordinary equity, the cost of what? Equity, right? You'll see the reason why I'm emphasizing these things is because this thing, like, honestly, ordinary equity is the only difficult, like, I would say it's the only difficult source of finance to calculate, right? That's why I'm emphasizing here, right? Others are not that difficult. And even though you, like, after you know this ordinary equity, it won't be that difficult. However, this is where they can really catch you. Otherwise, with preference shares and liabilities, there's not much they can do, but you'll see. So here it's the CAPM. So CAPM, what? It explicitly adjusts for risks, right? So you'll see here CAPM in its formula, right? You are explicitly considering risk, right? Whereas here you are not, right? You are just you're considering dividend, right, and growth, right? Do you see, right? That's the first difference here they have, right? And that's the first advantage that the CAPM has over the Gordon's dividend growth model, right? And then it is applicable to companies other than so it is applicable to companies that have like steady growth, right? So other than those companies that have like steady growth, so like normal companies, they don't have like steady growth in dividends, right? So sometimes the dividend is higher, sometimes it's lower. So this one is more realistic, right? And then the CAPM approach requires two things to be estimated, right? And this is basically its disadvantages, downfall. It requires what? The market risk premium and the beta coefficient to be estimated, right? You will see when I talk about them in the formula, right? And if those estimates are poor, the resulting cost of equity will be inaccurate, right? And just imagine if that cost of equity is inaccurate, and let's say the inaccuracy that we got is that we got a lower cost than what this thing is actually is, right? Then do you see that we will not be able to provide this value for the company, right? Because in the end, what is our goal is to come here, this growth, right? That's why we do. So that's the reason why we do everything here in finance, right? And then so let's go to the formula of how to calculate this cost of equity, right? Said RE is the expected return, and the expected return is the what? It's the cost, because it's the expected return that the equity holders expect from us. So for us, it's a cost, right? And then RF, it's the risk-free rate, right? So what is risk-free rate, right? Risk-free rate, it's a rate offered basically by sources of finance where like they are risk-free, right? Those are things like government bonds, right? So it's government bonds or treasury bills, right? However, if they give you a choice whether to use government bonds or treasury bills, always use government bonds, right? Because government bonds are longer term. If they give you a choice, though, if they just have the rate for the treasury bills, use that one, right? And the reason why it is a risk-free rate is because if you borrow money to the government, you'll definitely get it. Why? Because they can easily print out money, right? That's why it's a risk-free rate, and that's why we use that one here, right? And then plus what? Beta, right? So beta, okay, before we go to beta, this whole thing here. So this is the risk-free rate, right? Risk-free rate. So what are we saying here? They are saying the ordinary shareholders, right, are expecting at least what? This risk-free rate, right? Because they could have just taken their money and put it in that government bond without no risk and get a rate. That's why they expect it first, right? Then plus what? Plus this market risk premium, right? So this premium, right? And what is the market risk premium? It is RM, which is market risk. So this is the risk of the entire market or industry, right? Industry that company is within, right? So minus what? The risk-free rate, right? So it's a premium over and above the risk-free rate, right? So let's say the market rate was something like 10%, right? And the risk-free rate was 6. That then means that the risk premium is 6%, right? So market risk premium, what do they mean by it? What are you getting over and above the risk-free rate, right? And then that market risk premium multiplied by our beta, right? So beta basically is our risk compared to the market risk, right? Because this is the market risk premium. This is the premium you get from the market, right? So we have to multiply it with our conditions, right? Our sensitivity. I don't want to go deep here because you guys are not asked those questions, right? Just need to know that this is beta and it contains all the systematic risk. So this is where the systematic risk is, right? So this formula, you use it also. So with this formula, right, it accounts for only systematic risk, right, not unsystematic risk. And let me explain what the systematic and unsystematic risk means, right? So systematic and unsystematic risk, right, they come from a concept of diversification, right? So if they tell you that this risk can be diversified away, right, this risk can be diversified away. And let me give example of diversifying a risk. So there are risks that you can diversify away, right? And there are risks that that are inherent to that entity. So risks that are inherent to that industry, risks that are inherent to that industry are systematic risk, because there are risks. These are risks that affect basically every business in that industry, right? And unsystematic risks are risks that don't affect every business within that industry, right? Therefore, it means that you can diversify them away. I don't want to really go deep into it, because that's not the type of questions really that they ask you, right? But you have to know what this beta is, and the fact that it's systematic risk, right? So I really hope you understand this formula, right? So this is the risk-free rate plus beta, which is our systematic risk, multiplied by our market risk premium. And sometimes they call it equity risk premium. It's the same thing, right? So, and what is it? It's market risk premium, right? Market risk, market risk minus risk-free rate. So that's the cap M. Hope you get it. So now we can continue. So in, like I said, in most questions, they'll just give you information relating to one. So relating to this, so they'll give you, see stuff like risk-free rates, betas, and you know that you're gonna use CAPM. Or they can give you things like growth and dividends, then you know you're gonna use the quarterly dividend growth model. And then if they give you information relating to both, then I'm telling you now, choose the CAPM model, né? Unless in the scenario you can explicitly see that here this company is issuing dividends and it's growing at a steady rate. Otherwise, use the CAPM if you have a choice, right? But you'll see they will either give you information relating to this or this. Then you just use that formula, right? And we can continue to our next source of finance. Within equity, our next source of finance is preference shares, right? So we want the cost of preference shares. So with preference shares, we are going to use the, so with preference shares, we use the perpetuity formula, right? So you'll see this formula for the cost of preference shares, it's similar to the dividend growth model, right? So it's very similar. It's similar. It's similar to a point where it's the same actually, right? It's actually the same formula, right? However, with preference shares, in most of your questions, they will not basically have this growth. So they will not tell you anything about growth. They will say maybe these preferences, they grow at a steady rate. If they say these preference shares grow at a steady rate, or they don't give you the growth of the preference shares, then you know there's no growth. If they don't give you the growth, there's no growth, right? Then you know, what do you know? That you know that this dividend that they gave you, this current dividend that they gave you, right? It will be the same as next year's dividend. So this dividend that you use here, it's the dividend value that they give you there. But this D here also means next year's dividend, in this case. And then PO, like I said, is the market price of the of the share, right? And then F is flotation costs. So if they tell you any percentage of flotation costs that preference shares maybe require maybe 7% flotation cost, right? Don't forget to put them here, right? You're gonna have to say 1 minus 0.07 for that 7%, right? Because those flotation costs have to be taken out. And what are these flotation costs? These flotation costs are things like issuing costs. You know, like to get this funding, you're gonna have to incur some costs, right? That those are called flotation costs, right? And then you do it like this if they are flotation costs. However, in most cases, for your level preference shares, it's going to be like this. In most cases, your formula is going to look something like this, right? When I have your D here, and you're gonna have PO. The reason why I put this thing here, it was for completeness sake, right? So the reason why I put it here was for completeness sake, right? So to be complete, right? However, in most cases, it will be like this, because in most cases for preference shares, they won't put any growth, right? So you won't have this G basically, and there won't be any flotation costs, right? However, if they do include growth and flotation costs, you know you use this formula, right? Yeah, that's for preference. So that's the cost for preference shares, right? So that's the cost for preference shares. And then with regards to flotation costs, so flotation costs, do you remember here when I said they can ask you basically they can ask you the cost, right? So here when I when I basically said that for the cost, if they say they want the cost, they're gonna want a percentage, right? Or an amount, right? So, and I said an amount, most probably it will be for flotation cost. So in other questions, right, they're gonna ask you what is the amount of flotation costs, right? So the value of the flotation costs, right? So they're gonna tell you that this entity is planning to invest something maybe like 2 million, right? And then flotation costs relating to that, they give you percentages of flotation costs relating to that. Then what you have to remember is that, right, in that case, and I will do a question on that. What you have to remember is that these flotation costs, right, these flotation costs, you have to pay them, right? So what must happen? Whatever value of equity you get, so let's say in that case, I got you need 2 million, right? You need 2 million for this investment opportunity. Whatever equity, whatever, I mean, financing you get, right? So whatever financing you get, it must be equal to 2 million for the investment opportunity, right? So that means that after deducting flotation costs, it must be equal to 2 million, right? That means that the flotation costs, that means that what you're gonna ask from these source of finance is going to be more than 2 million because it must include these flotation costs. But I will show you in a question what that means. So that was basically the source of finance preference shares. So we have basically three sources of finance. We have not three, we have more than three, but I'm gonna go through basically three because these are the most important. So we have ordinary shares, preference shares is the second one, and the third one is loans, right? So loans are a type of liability, right? And then for loans, they're gonna just say or ask you the cost of debt, right? And like I said, the cost of debt here is basically the after cost of debt, right? So the cost of debt is the after cost of debt. So you see, this is the um, the rate of return, right, that they want. So the interest rate that they want before tax, right, of debt. And then here you are removing the tax, right? So here we are removing the tax. That's what I'm saying. For cost of debt, um, after tax, right, cost of debt is the cost of debt, right? So it's for liabilities, it's not that complicated. And then another source of finance for liabilities, right? For liabilities, sometimes you can see, something like current liabilities, right? Current liabilities are also liabilities, right? But why didn't I specify them here, right? That's because current liabilities, in most cases, I'm not saying in all, right? In most cases, the interest that they give you there is 0%. So there's no interest in most cases for current liabilities, right? So if they say calculate the cost of the current liability, instead you're just gonna say, if you don't see anything, then just say 0%, because in most cases it's 0%, right? Because you are dealing with the creditor here. So those are the types of basically sources of finance that they can ask you, and how to calculate the cost, right? So now you know how to calculate the cost individually, right? So now we can go to what is this thing, what is WACC, what is this weighted average cost of capital. Now that we know what is cost of capital, we want to know what is this weighted average cost of capital, right? So this weighted average cost of capital, right, comes from what principle? This principle known as the pooling of funds principle, right? This principle is very important. This work comes from the principle of pooling of funds principle, right? Now I'll explain why we use this principle by way of an example, right? By way of an example. So let's say you have an investment idea, right? Investment opportunity, I mean. So you have an investment opportunity, right? And let's say this investment opportunity promises to give you a yield of something like 10%, right? Promises to give you a yield of 10%, right? So this thing promises to give you a yield of 10%, right? And let's say for this one, so we calculated basically its IRR, right? And we saw that it's 10%, right? And you know that our cost, basically cost of capital, cost to buy this thing has to be less than the 10% in order to actually make money, right? So let's say here we say to fund this investment opportunity, we are using equity. We are using equity to fund this particular investment opportunity. And equity holders, what do they want? They want, let's say they want 14%, right? Now, so these equity holders, do you see that they want 14%? So what will happen, right? We are going to reject this investment opportunity. Why? Because do you see that it's paying us way less than what the equity holders want, right? Which is it's basically giving us an NPV of minus, right? In this case, right? So I'm not using NPV, I'm using IRR. But in this case, it will give us an NPV of a minus, right? That means that this investment opportunity will not work. We are earning way less than what our our equity holders want, right? So we won't take this decision. We are going to reject it as a result of this, right? And let's say another investment opportunity comes. This one is 9%, right? Right. And for this type of investment, let's say this type of investment is called investment. So we categorize them. We call them investment A and investment B. And we say investments in investment A. So investment A, we are using equity. For investment in investment B, we are using debt, right? And let's say the debt here, the percentage here that we get. So after tax cost of debt, maybe let's say we get something like 6%, right? We get something like 6%, right? What are we going to do here? Do you see that the IRR that we are getting, right? The internal rate of return, we are getting way more, right? Way more than what we are paying. We are getting basically a profit of 3%, right? A wealth increase, right, of 3%, right? Because basically what we did, we had this investment opportunity, we borrowed money from these people and they only want 6%, but we are getting 9%. So that's why we're accepting it. Whereas this one, you're gonna reject it, right? That's what happens, right? Now, do you see that if an entity does this, right? This is very stupid, right? Because you are in the same entity, right? You can't be using different sources of finance um to finance investment decisions, right? Because look at what happened here. This investment decision came that promises us 10%, right? However, we rejected it. How then, let's say in a month or in a month or two, this decision comes that offers us a less return than what this one was offering us, right? However, we are accepting it because of the source of finance we are using, right? Do you see that when you're doing that, like that's like, if you're taking decisions like that won't be very good to the company, right? Because you lost like higher, but you're getting a lower amount, right? So what does this thing mean? It means that investment decisions, right, must be done separately from financing decision. That's what this thing means. It means that you cannot make an investment decision and financing decision at the same time, right? You have to do investment decisions separately from financing decisions, right? So what does it mean? It means that overall, right, an entity will take a decision, right? An investment decision, right? And after it takes the investment decision, let's say 10%, right? What will it do? It will ask itself not which funding am I going to use for it, right? You're just going to ask what is the cost of funding, because these two funds are going to be pooled, are going to be put in the same fund, they're going to be put in the same account, right? So it doesn't matter whether it borrows from here or here, right? We just have to find the average of these two, right? We just have to find the average of these two, hence weighted average cost of capital, right? I hope you get it. That's the reason why we do WACC, weighted average cost of capital, right? Because these investment decision and financing decision you have to take separate, right? That's why we do WACC. So I think we'll continue. Okay, so yeah, so back here. So like I said, all permanent source of so all permanent capital, and I'll explain what this permanent means. So all permanent capital is put into one account, right? That's this principle. All is put into one account, and investment decisions are done separately from financing decision, right? And the reason why I'm saying they are put into one account, it doesn't matter whether that money comes from equity holders or it comes from a loan, right? Let's say you get something like 100,000 from a loan and 50,000 from equity holders, right? It doesn't matter whether you use 1 rand from equity holders or the 1 rand from the loan. 1 rand is 1 rand, right? That's why they are put into one account. The only thing that's different between them is their cost, right? That's why they are put into one account. I hope you get that. And then the decision on the capital structure, okay, can be given or use market values. Okay, this one we'll consider later. So this is what we are doing here. So pulling off funds principle, right? And why do we do work? This weighted average cost of capital, right? We want to get the lowest work. That's our objective, right? That's our objective, to get the lowest work possible, right? That's our objective. Now we're going to implication. How do we actually determine this work? What is this work, right? So firstly, like I said, work, we have to identify what all permanent sources of finance the entity will use, right? So all permanent sources of finance the entity will use. So even with work, it depends what work they ask you. They might ask you to calculate the work for a specific division, right? So you know that you're calculating only a work for that division. So you need permanent source of finance of that division, not of the whole entity. However, in most cases, they will ask you to calculate the work, just the work. So it will be the work of the whole entity. So the first thing is determine all the permanent sources of finance, right? And what is a permanent source of finance? It is a source of finance the entity is willing to use for the entire investment term. That's what permanent means. So do you see that I didn't put in words like short term and long term? It's very important that permanent does not mean long term, right? Although long-term source of finance can be permanent, right? Permanent doesn't mean long-term. It means that you're willing to use it for the entire investment term. So let me show you what I mean, right? So a normal loan, the reason why a normal loan, we take it as a permanent source of finance, right, is because in most cases a loan it's a long term, so it'll go for the entire term of the investment, right? Long term sources of finance, in most cases they go for the entire term of the investment, and that's what you assume. And then of course ordinary equity, it's definitely for the entire term of the investment, right? You don't take out ordinary equity. And also preference shares, right? It's for the entire term of the investment, right? And then let's say they gave you a loan, and then let's say this loan, they tell you that after maybe 1 year or 1.5 years. So do you see it's a long-term loan? 1.5 year or 2.5 years, right? They will not roll over this loan. So you know what entities do? They roll over finance, right? The rollover finance. And what does rollover mean? It means that let's say we took 5 million from the bank, right? If we choose to use that 5 million as a permanent source of finance, it means, what does it mean? It means that after we pay the bank, right, at the end of whatever term, let's say they gave us that 5 million for 10 years. After we pay that bank for 10 years, that bank is going to give us 5 million again, right, to use in our operations. So that's what you're doing. We are rolling over that debt. We are continuing with the debt. You see that debt is permanent in nature. Now, if they don't tell you that they are rolling over that debt, meaning they are continuing with that debt, right? And they tell you maybe it ends in like 2 years or 2.5 years, maybe 1 year. Do you see that is not permanent because it won't go for the entire term of the investment? So that source of finance, that long-term source of finance, if maybe in that case it's long-term, will not be permanent. So you will not include it in your calculation of work, right? So that's the first thing you have to do, right? And then identify these permanent sources of finance. And then after you have identified them, do you see? So you identify them and then list them in this table, right? So you list them in this table, permanent source of finance one, list them in this table. And then second one is determine the target capital structure, right? And weighting, right? So weighting means weighted average, this WA, weighted average, right? So determine the capital structure and the weighting, right? And how do you do that? And what is the target capital structure? So target capital structure, you can determine it in two ways. Firstly, it can either be given to you. So they're telling you straight that we want to use 40% of equity, maybe, and 60% liabilities, right? Then they already gave you the capital structure. You don't have to calculate it. You already know that they're going to use 40% equity, 60% liabilities, right? However, in most questions, they won't give you this capital structure, right? If they don't give you the capital structure, then you're going to have to use market value. So the market value of the permanent source of instrument at that time. So the market value, right? You're going to firstly have to determine the market value of each source of finance. Do you see the market value of each permanent source of finance? Now that you've listed them here, the market value of each permanent source of finance, right? And then after determining the market value of each source of finance, you are going to add them up and get a total here of market values, right? And then what you're going to do is you're going to take this total here and say this amount divided by this total multiplied by 100, which will give you the weighted average, right? Weighted average is sort of like a percentage, right? Sort of like, yeah, a percentage, right? So that's the weighting. So it's this divided by this. You can put it there, or you can say this divided by this times 100. I like to say times 100 to make the weighting a percentage, so that after I just take all of these weightings, add them up together and make sure that they are equal to 100%, because all of these weighting have to be equal to 100% at the end, right? That's how you determine this weighting. And if they didn't give you, so if it wasn't market values, right? So that's how you do it when they give you market values. If it's not market values, right? You are just given the capital structure, maybe 60% equity, 60% equity, 40% debt. What you're gonna do is here, I get you won't have market value. This block you can just skip. For every permanent source of finance, you're gonna check, is this permanent source of finance equity or liabilities? If it's equity, we said equity 60%, right? In that example, you're gonna put 60% here. If it's liabilities, you're gonna put 40% for liabilities, right? That's the weighted average, right? And then we go to, we continue. So the next one is say determine the cost for each source of finance, right? So you want to determine the cost for each source of finance. And how do you determine the cost use for each source of finance? You're going to use the rules for determining the cost of capital here. These rules, the rules that we are doing here, right? Normal rules of calculating the cost of capital, right? For this one, normal rules of calculating cost of capital. So for each source of finance, you're going to calculate the cost of capital using the normal rules of calculating cost of capital. Do you see? This is where this is where what we did, like so this is where it is. This is where it's assessed, right? This is the cost of capital. And then after, what do? You're going to multiply these two, right? So you're gonna multiply this percentage times this cost, and it'll give you basically a portion of the work, right? Then this cost, this weighted average times the cost, a portion of the work. And then after, you're gonna add all of these portions, and then that'll give you the weighted average cost of capital, which is the work, right? So that's how you determine work, right? So that's work. I hope you understand work. And yeah, that's basically our transcript. So we are basically done with what cost of capital is. So we firstly did why we are doing cost of capital, right? We 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 delve into what cost of capital is, right? Now we're going to do how to actually do it in a question, right? Which is the framework. So these are the steps of how to do it in a question. So let's say the first question, the first type of question can ask you, determine the cost of capital, right? So here in this question, step one is what model or method to use, right? If let's say it's preference shares, you know that there's only one. Liabilities, there's only one for loans. And then for cost of equity, you know that there's stage two. So you have to choose if they gave you both information, right? And then second step is just calculate the cost of capital using that model, right? The appropriate method. So this one is easy. And then for work, the steps are first determine all permanent source of finance, right? Determine the weighted average using what? A target capital structure as usual. And then determine the cost for each source of finance. And then after, determine the work. So now let's see how we can apply these things in a question, right? So you're gonna go to this question. This is your 2018 question, right? So I'm not gonna do all of it, but I'm gonna do the parts that I think that they're gonna assess you guys on Friday's test. So let's start here, right? So the reason why I also want to go through here is because there are some concepts of social finance that I obviously didn't cover in total here for cost of capital, because cost of capital is a topic on its own. I just want to cover them as I go through this thing. So I'm going to do question one. I'm not going to do question two, but I am going to discuss it, how to approach it, and question three. Then question four, yeah, question four is also work, yeah. However, question five, do you see that's talking about um, like NPV and IRR? So NPV and IRR, I'm not sure if they're gonna ask you. I don't think they're gonna ask you guys NPV and IRR, because you still guys, you guys have a topic, right? Still the valuations. So I think they're gonna ask you valuation instead of this. So I'm not gonna cover this part. I'm just gonna do the work today. Then valuations, um, please, with that one, I don't think it's going to be the majority of the test. I think the majority of the test is gonna be financing, right? So let's start. So with question 1.9 says the existence of on the statement of financial position generates tax advantage that directly influences the capital structure of the firm, right? So what is that? What has tax advantages, right? Remember, it's a statement of financial position and it has tax advantages, right? And they're talking about which capital. So which capital has tax advantages? Obviously, it's liabilities, right? So, and what type? Long-term loan will be the long-term loan, right? It's liabilities, because large portion of fixed asset that doesn't make sense. Fixed assets that don't generate you a tax liability. However, liabilities, you have a tax advantage, right? Because the interest is tax deductible, right? Right? And you understand what that means, right? Here, right here, like for instance, here, do you see it's tax deductible? That's what it means, right? And then we go here. So, okay. So then question 1.2, it says, assume that the economy has unexpectedly and immediately gone into a recession, right? Which of the following firms are in that are in the same industry and exposed to the same business risk would most likely experience a large increase in the present value of bankruptcy costs, right? So bankruptcy, basically, you know what bankruptcy means? It basically means if your liabilities are greater than your assets, right? Then you guys like on a bankrupt position, right? So in a recession, which entity will experience it? So they say a firm with the highest proportion of equity financing. Okay, let's check another one. All firms will see an identical increase in the present value of bankruptcy cost since the business risk is the same. No, this one is definitely wrong, right? Why? Because a business has two types of risk. It has business risks and financial risks, right? And that those two risks, both of them, they determine the value. They determine the value basically of the business, right? Like I said, when you're taking decisions, they have to have value. So decisions are there to increase returns, right? However, you have to identify all the risks that are associated with that decision. So for instance, decisions relating to financing, there's financial risk related to that. So there's no way this is right? Because businesses have different, even though they're experiencing the same business risk, they have different financial risks, right? And financial risk, do you know what financial risk just means? It means that the ability or the inability, right? The inability to pay your debt in time. That's what financial risk means. So inability to pay your debt in time. So every time you see an entity taking a loan, you know that the financial risk increases, right? Because the ability to pay that debt will increase, right? And then C, a firm with the highest proportion of debt financing, definitely, right? Definitely will experience higher bankruptcy cost, right? Because why? The business risk, definitely they will act the same, right? But the firm with the highest debt financing is the one that's really in trouble, right? in this case, therefore it's C. Then we go to 1.3. It says an increase in leverage is likely to result in N. Okay, so firstly, let's talk about leverage. I want to explain what this thing means, this leverage means. Please note this one down, because it's very important. So leverage, there are two types of leverage. So there's financial leverage, right? And um, operating leverage, right? Financial leverage and operating leverage, right? Leverage in total, right? This is what it means, the definition of leverage. It means you are benefiting from paying a fixed cost. That's what leverage means. Benefiting from paying a fixed cost. That's what leverage means, right? So let me give you an example. And in your case, I'm only gonna give you example of financial leverage because you guys here, you are not, I didn't see a question dealing with operating leverage, right? So I'm just gonna explain financial leverage. So what does it mean to leverage, right? Think about it like this. If you get financing from equity holders versus liabilities, right? What is the advantage of getting from liabilities other than its cost, right? Number one, liabilities have a lower cost than equity, right? Number one, right? That's the first advantage of taking liabilities over equity, right? It's because firstly of the cost, right? The cost of liabilities is normally lower than the cost of equity. Why? Because equity holders are in a much more riskier position than liability holders. Therefore, they expect more than liability holders, right? And then secondly, right, the best advantage, and this is the best advantage of debt, right, is the fact that, like I told you, right, when you start when you're here on the objective driver, right, I told you right here that these are the people that are actually, these people are actually investing in you, right, as an entity, right? Although it's a cost to us, they are actually investing, right? Do you see that they are actually investing, right? And do you see that this one, right, the liability holders, you only want a fixed return. So if you wanted 10%, it will only be 10% forever, right? However, equity holders, right? Equity holders. The reason why this is a problem, like this basically, like for equity holders, like we say you are leveraging on debt, is because equity holders are going to want a variable return, right? So let's say your returns as a business in total, the returns that you got, let's say are 40%, right? What's going to happen if like it's 40%, right? Your debt holders are gonna take that 10% because they want their 10%, right? And then the remaining, do you see the remaining amount? What does the remaining amount belong to? It belongs to equity holders. Do you see? And it doesn't matter how much, like let's say even if like the return is 50%, debt holders will always receive 10%. It doesn't matter, they will always receive that 10%, meaning we are paying the same amount for like a higher return. That's what leveraging means. Do you see that? Because debt, we are paying a fixed amount, like an amount that's already set in stone. That's why we are leveraging from it. But you can only leverage from something if what? If you are making a profit only. Ne? Otherwise, if you are making a loss, then there's no way you're going to leverage. If you're making a loss, it's a negative leverage, meaning you are losing money as a result of that. You're losing money at a fast rate as a result of that. So leverage can be a good thing or a bad thing. It's a good thing when you are in a high growing business, right? A highly growing business and a highly profitable business. Then leverage is the best thing to have, right? But if you are a business that's struggling, right, and that's not really profitable, right, then that means that you are gonna be in a worse off position, right? Right, you're gonna be in a worse off position because of that leverage, because of that fixed cost, right? So in this case, when they talk about leverage in this case, when they talk about leverage, in this case, they're talking about financial leverage. So let's continue. It says an increase in leverage is likely to result in an increase in, it says, business risk, and return. So in this case, I said if they talk about leverage, they're talking about financial leverage, right? So what do they mean here? An increase in financial leverage is likely to result in an increase in business risk and returns. No, right? Because it's financial leverage. If it was operating leverage, then yes, business risk and returns, but it's not. So we go on to the next one. An increase in financial risk and return, yes. Why? Because an increase in leverage, like I said, which means it's an increase in financial leverage. It means an increase in debt, right? And like I said, an increase in debt is what? Increase in financial risk, right? Because the risk to not pay them, it increases, and that's financial risk. And then increase in it will also increase what? Returns, right? Like I said, leverage, it multiplies basically returns, right? This leverage effect if you're making profits. So that's 1.3. And then 1.4, it says flotation costs for a firm is computed as, right? So flotation cost for a firm is computed the mathematical average of flotation cost of both debt and equity, right? And they say the weighted average of flotation cost associated with each form of financing. Okay, this one is the weighted average flotation cost associated with each source of financing, right? And with this one, I will explain it in question 3. We're going to do a question now, question 3, that explains this flotation cost, right? Because we're going to have to know them. But just know that flotation cost for a firm is the weighted average flotation cost, not the mathematical average, right? Weighted average flotation cost, right? 50% debt, 50%, this one is wrong, right? Yeah. So can continue. Now, question 1.5, it says the cost of capital assigned to an individual project should be the rate which, right? So yeah, should be rate corresponds to the level of risk of the firm's division, which has responsibility for the project, right? Now, with this one, honestly, this question, these especially the answer for A and D, it's very close, right? But the answer here it's actually D, right? It's actually D because but they say the cost of capital assigned to an individual project should be the rate at which it considers both the nature and characteristics of the actual project, meaning it considers basically the whole project, right? The whole project, not the division, right? Yeah. So this case they are wrong because they said division, right? And they said this one it corresponds to the deleted pre-tax, definitely not pre-tax, because like cost of debt is definitely post-tax, after tax, right? So not B. And then it says it's the industry weighted average. No, 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 no. It's not the industry weighted average. When they're talking about industry weighted average, they're talking about weighted average of all of the companies in that industry, right? And that's wrong because they say the cost of capital assigned to an individual project, right? So it's the cost of capital for that entity. So it considers both the nature and characteristic of the project, right? So it's very important to note these words that they use, project, division, and yeah, it's very important to note them. Okay, we can continue. And then 1.6 says Power Limited is evaluating a 5-year project with a positive NPV of 250,000. The project requires an initial investment of 500,000. Um, the company has an estimated work office 16%, right? So I don't know if you guys are still doing this thing, profitability index. Because I'm not sure you're doing it, I'm just gonna give you the formula for profitability index because this thing is really not important, right? So sometimes they call it the profitability index or they call it MPVI, right? Net profit, net profit, net present value index, right? So this is the same thing. And the formula for this is 1 plus PV, right? 1 plus PV over initial investment, right? That's the formula. 1 plus PV over the initial investment, right? So what's the NPV? It's 250. So you're gonna say 250,000, right? Divided by, so 250,000 divided by the 500,000, right? Which gives us 0.5, right? And then plus 1, which gives us 1.5. So we know that the project has a profitability index of 1.5. So we want an answer that has 4 So the answer that is number 4 is C and D, right? And let's see which one is right. So C, it says 1. Nah, it's wrong. It can't have both 1.5 and 5. So it's D. The answer is D. Can move on. Okay. It says the ordinary shares of Bluebird Limited have a required return of 8%, right? And a growth of 4%. The recent annual dividend was 0.6 percent per share, right? Then they said calculate the current price of this share, right? Do you see that they want the price of the share, right? And they gave us information relating to what the first model to use, right? Which is the Gordon's dividend growth model. So we're gonna write the formula, which is PO, right? Is the price of the share is equals to D1 divided by RE, right? RE minus G, right? So that formula, right? And then, so what is PO? PO is the current market price, right? So that's what we want. PO is what we want. And what is D1? D1, we said it's next year's dividend, right? So they told us that the recent, do you see what I said? The recent annual dividend, right? So this year's dividend was 0.6. So what must you do? We must say 0.6 multiplied by what? 104%, right? 104%. And then you get 0.624, right? 0.624. That's the dividend for this year, 0.624, right? And then divided by what? By the growth, by the this, right? By this. Right? So this is the required rate of return, which is 8 minus 4, right? So we are going to say 0. So this is the answer here is 4, right? So we're gonna say 0.624, right? That we got for D1, divided by what? 4%, right? Divided by 4%, and that gives us 15 rand 60 cent, right? Gives us this answer, right? Then we can move on. Okay, we can move on to the next one. 1.8, it says Ben's Ice Cream just paid an annual dividend of 0.75% a share, right? And they said the share has a market price of 32 and the beta of 0.9. The return on government bond is 4%, and the market has an average return per annum, right, of 12%, right? So what do they say here? Calculate Ben's cost of equity, right, for the capital, right? So do you see that here they what information did they give us? Do you see that they didn't give us the growth here? There's no growth. So we're not using the dividend growth model, we're using the CAPM model, right? So CAPM model. So I'm not gonna write the formula down this time, right? I'm just gonna say it. So it's RE is equals to what? The risk-free rate, right? Number one is risk-free rate. Let me go here and illustrate it. So the first one is risk-free rate, right? Risk-free rate, right? So the first one is risk-free rate. And what is the risk-free rate here in this case? It's 4%, right? So we're gonna say 4%, right? Plus 0.9, which is the beta, right? Beta is 0.9, open bracket, right? What is the market rate? Is 12% minus 4, right? And then this will give you the answer, right? Whatever answer it is. I'm not gonna put it in a calculator, so you will put in a calculator and whatever answer it gives you, you'll get it here, right? You can move on. Okay. So the next question, 1.9, it says Terry's Tires has 7% preference shares outstanding that trade at 68 rand per share. Similar preference shares currently yield a return of 10.29%, right? So do you see they want the cost of preference shares here, right? Do you see there's no growth here, like I said, and there's no flotation costs. So we know that determining its cost, it's as easy as this formula. So removing the growth and the flotation costs, right? So what's going to happen is, okay, here it's the RE here, it's the R, it's the rate, right? So firstly, the first thing wanna, so this is the, it's so it's market rate, right? And they gave us for a similar, so a similar preference share, right? So we can start by determining, so one determine this dividend, right? So we can start by firstly taking the 68. So this 68 multiplied by 10.29%, right? 68 multiplied by 10.29%, right? Then you get 6.9972, right? 6.9972, right? That's the dividend, right? And then we divide by R. R is the rate, right? The required rate, our required rate, so which is 7%. So we're gonna divide that 6.9972 divided by 0.07, right? So 6.9972 divided by 7%, right? So divided by 7%, and then you get this 99.96, right? And that's how you do that one. Okay, we can move on to the last question for question one. So it says Auto Group has 1,200 bonds outstanding that are selling for 980 each, right? So that's okay. And they say the company also has 7,500 preference shares trading at a market price of 40 rand each. The ordinary shares are priced at 32 rand per share, and there are 32,000 shares outstanding, right? And then they said calculate the weight, the weight of the preference shares as it relates to the company's weighted average cost of capital, right? So do you see what they want? When they say weight, they are talking about basically its percentage, its weighted average, right? They're talking about what? This. So just this portion, but the portion only relating to what? Only relating to preference shares, right? So that's exactly what we are going to do. We're gonna firstly do that table, right? But I'm not gonna draw the whole table. So here you have your permanent sources of finance, right? So we have your firstly we started with bonds, right? We have your bonds. Um, we have your, so bonds are just liability. So we have your bonds, we have your preference shares, right? And then we have your ordinary shares, right? Now, what do we want? We want the market value for each, right? At this point. So what is the market value for each? Market value for bonds, they say they are selling for 980 each, which is the market value. So we say 1.2 multiplied by 980, that gives us 1,176,000, right? So 1,176,000. So I'm not gonna write all of these zeros. So I'm just gonna write it here. So this is 1,176,000, right? And then the next one is preference shares. So preference shares is 7,500 multiplied by 40, right? That gives us 300,000. So this one is 300,000. So 300, okay, thousand. And then for the ordinary shares is 32 multiplied by 32,000, which is 1024, right? Thousand. So 1,024,000, right? And then what is the total here? It's 2,500, right? 2.5 million. That's the total here, right? And then we want its weighted average, right? So here it's the weighted average, right? We want its weighted average. Like I said, weighted average is simple. You just take this, but we want only for preference shares, right? So we just take this preference shares, so 300,000. So you just say 300,000, right? Divided by 2.5 million, right? And multiplied by 100, that gives us 12%, right? So this is 12% here, right? So this is the 12% here, which is the answer here, right? So that's how you do that one. We can move on. Okay. So with this one, you just have to know this guy's proposition. So there's an approach that um, these guys have. Just know its approach. I'm not sure if they still ask you guys these type of question, because this is a 2018 paper. Mare, when I looked at the work that they gave you, I didn't see this explained. Right, so I'm not gonna go through it today. So I'm gonna come here to question 3. So question 3, it says Dimension Limited has a target capital structure of 60% debt and 40% equity. The company is currently assessing the viability of a capital project which has an initial investment of 5 million and a positive net present value of 457,800. The NPV was calculated without taking into account flotation costs, right? So we have this concept of flotation cost, and they tell us that this NPV was calculated without taking into account the the actual flotation costs, right? And then they say they have requested your assistance in finalizing the NPV calculation, right? Which will be used to either accept or reject the capital project, right? And they say Dimension has a work of 16%, right? And the flotation, so that's before taking work into account. Then flotation costs, the flotation cost of equity are 12% of the amount raised, and flotation cost of debt are 7% of the amount raised, right? Then 3.1, it says state whether it's correct to adjust the work to reflect the impact of flotation costs. No, right? It's not. You don't have to adjust the work to um include the impact of um flotation costs, right? Because the work is only impacted, so you only change the work when there is risk to the asset, right? Flotation costs are not risk to the asset. So if there's risk to that specific asset, right, they're telling you for that specific asset or project, right, telling you maybe that these cash flows, maybe there's a risk that something like this will happen, like a business risk straight, then you're going to adjust the work. But because there's no risk here, like really um these flotation costs, like I said, they are issuing costs, right? They are not risks, right? So they are not included in the cost of capital. And also the reason why they are not included in the cost of capital is the cost what that you are paying to your sources of finance, right? So do you see that flotation costs like should not be included here, because you're not gonna pay them, you already paid them, you already did that, right? So it must not be included, must not be reflected on the work, right? So like they say here, this thing, it must not be adjusted, right? They must not be adjusted, right? Then you can go to the next one, right? And assuming that the work should not be adjusted to reflect the impact of flotation cost, explain how flotation cost should be accounted for, right? When calculating NPV. It's the same thing like I said there, that should flotation cost should be included as part of relevant cash flows, right? Why? Because flotation costs are not really a cost of capital. You take them out, right? You take them out when what? When you are getting these sources of finance, right? So you're expecting to see this cost at inception of that project, at the beginning of that project, right? So that's why they're not really included in the work. However, they must be included as relevant cash flows for that specific capital project, right? Because you are paying them at the beginning, so they will be there at year zero, right? They will be there at year zero, right? Can continue. Then 3.3 says calculate the weighted average flotation cost of Dimension Limited, right? So this is where this thing comes now, this weighted average flotation cost, right? Now, do you see that, like I said, flotation costs are costs what? Costs like issuing costs, right? And underwriting costs. So costs basically to retrieve that financing, to get that financing, right? Now, you can get flotation costs for, like you can have many flotation costs, right? You see here, you have more than one flotation cost. If there's one, then you would have known its cost, right? Now there are two, right? There are two flotation costs, right? Flotation cost for the cost of equity and flotation cost for the cost of debt, right? And now remember, we said we calculate flotation cost at the beginning, right? Why? Because for a certain project, we know that for this project, we know that we need how much? 5 million, right? We need 5 million for this project. And the reason why we are calculating this weighted average cost of capital is to calculate how much more do we need to retrieve from these shareholders, right? Or equity or debt providers, right? How much more other than this 5 million to cover these flotation costs? I'll see what you'll see what I mean. So here it's calculate the weighted average. So you're gonna calculate it the same way. You see weighted average. Weighted average means the same thing, right? So we're gonna start firstly with the weighted average. Do you see that they're giving us the weighting is 60 and 40%, right? They already gave us the weighting, right? So we have our 60% here, right? And we have our 40% here. They already gave us the weighting, right? And what is the cost now? We want the cost, right? We want the flotation cost, right? Because in the end, we want the weighted average flotation cost, right? Which is WAFC, right? So this is flotation cost. So do you see when you say this multiplied by this will give us the weighted average flotation cost? So here, for equity, okay, this is debt is 60%, so it's 7 here. For equity, it's 12, right? It's 12%, right? So now let's calculate the answers here. So firstly, we're gonna say 60% multiplied by 7, right? 60% multiplied by 7, 60% multiplied by 7. That gives us 4.2, right? 4,2, right? And then you say 40 multiplied by 12%, right? So 40 multiplied by 12%, that gives us 4.8, right? So it's 4.8, and then 4.2 plus 4.8 gives us 9%. So what's the weighted average flotation cost? 9%, right? So weighted average flotation cost is 9%. You see how it's done here? It's 9%, right? It's 9%. Now we go here. Okay, can go to this one. Next question, it says, assuming that the weighted average flotation cost of dimension is 10%, right? Calculate the correct NPV of the project after taking into account the flotation cost. So they want the NPV after taking into account flotation costs, right? So what do we have to do firstly? We have to use this weighted average flotation cost, right, to determine what is the value of the flotation costs, right? Now, they told us that the value of the flotation cost is 10%, right? It's basically 10%. And what does that mean? It means that this 5 million represents what, right? It represents 90% of the value that this company actually has to get from these equity holders. So it represents what? This 5 million represents only 90% of what they actually have to get. Why? Because 10% of it is going to go to these flotation costs, right? So if this thing represents 90%, right? We want, so how do we get flotation costs? We just make it to, so we just make this thing represent what? 100% first, right? So we make this thing represent 100%. So let's change this thing to represent 100%. And how do we do it? We say 5 million, right? 5 million, right? 5 million multiplied by 100, right? Over 90, right? Multiply by 100 over 90. Because why? This thing is 90%, right? We want to change it to 100%, right? So we say 90 over 100, right? So that's how we change it to 100%. So this represents 90%. We change it to 100%. That's how we do it. And our answer here is, so it's 5 million multiplied by 100 divided by 90, which is 5, so it's 5, 5, 5, 5, 5, 5, 5, comma 5, 6, right? And then what are we gonna do to get the amount of the flotation costs, right? This is the amount that we actually want, right? So we just say minus 5 million, right? The amount that we want. Obviously, the amount that's left, this 555,56, that's our new flotation cost, right? But that's not the question. The question says calculate the NPV of the project, right? After getting these flotation costs. What did I say? These flotation costs, you are going to incur them at the beginning of the year, right? So if this is the value of the flotation cost, right? That means that the NPV must what? Minus it with the flotation cost, because the flotation costs are paid at the present value, are paid present, right? That's why we have to minus it. Then therefore we get a minus NPV. Do you see here, right? Get a minus NPV as a result, right? That's how you do that type of question. Then last question you're gonna do today is question 4, which is actually work, right? So let's start. It says um, Zara is a clothing retail company listed on the JSE. Zara specializes in designing and manufacturing African traditional clothing. The following information is extracted from Zara's annual financial statement, right? So this one is extracted from that. We can tell here that, okay, they have equity, okay, this debt. Okay, they gave us other additional information. Let's look at the question. The question says calculate the weighted average cost of capital. Now, this is a question that at least we know, and we do have a framework for it, right? Determine the weighted average cost of capital. What did they say here? Calculate, right? Calculate the weighted average cost of capital. So we're gonna use this framework, right? So what did we say in this framework? We said firstly, determine all permanent sources of finance, right? That's exactly what we're gonna do. Start with the table, right? This is the so this part is for a permanent source of finance. And what do we have? We have our ordinary shares, right? Ordinary shares. So we have our ordinary shares. That's the first permanent source of finance or capital, right? And then the second one is the debt, the long-term debt, right? Do you see that in this question, the problem wasn't choosing? Sometimes the problem is choosing, right? So if the problem is choosing, then you have to just see which one is permanent. But here, the problem was in this part here, right? And then let's look here that they gave us the capital step. Okay, that's step 1, right? So what is step 2? Step 2 says determine the weighted average using the capital structure, right? Okay, that they give us the capital structure. No, there's no capital structure given, right? Because there's no capital structure given, we have to firstly calculate or use market values, right? Use market values before we can get the weighted average, right? So what's the market value for ordinary shares? So let's get the market value for ordinary shares. Okay, they tell us that um, ordinary shares trade at 10 rand 44, right? So this is its market price. So we're just gonna take this 10 rand 44. So 10,44, right? Multiplied by 3 million ordinary shares, right? How many ordinary shares are there? 3 million ordinary shares, right? So multiplied by 3 million, and then that gives us 31 million, right? 31 million 320,000, right? So I'm just gonna write the zeros here. Okay. Then even in a test, now you see this thing that I'm doing, this is also a test technique. If you see that a question has a lot of zeros, please start doing this, right? Because I'm telling you, I don't know how many mistakes I've made with these zeros. I always have a problem with these zeros, and I know that the problem is not only with me, like there are some that are actually getting wrong because of these zeros. So please, if you see that the question has many zeros, like do this, right? And then we are okay. We found the market value of the ordinary shares. Now we want the market value of the long-term debt, right? So okay, this is information relating to the ordinary shares. Okay, long-term debt. They say the long-term debt forms part of the permanent capital structure of Zara. Okay, we already knew that. Similar long-term loan can be replaced at the rate of 14%. So this is the market rate of the loan now currently, right? And then 12%. So now we want the market value of the loan. How do we get the market value of the loan? The market value of the loan is the present value of the loan, right? Using this market interest rate, right? So it's the present value of the loan using the market interest rate. That's the market value, right? So what do we do? Firstly, we start with the, okay, this is what we want, the PV, right? We firstly want this thing, right? We want the PV, right? The N we don't have, which is okay. Then we basically are given what? The I, we are given the I is 14%, right? Because we want the market value, so you're gonna use the market rate, 14%, right? And the PMT we know the payment, right? What is the payment that you're gonna pay? It's what? It's 12% of this 1.5 million, right? 12% of this 1.5 million. So 12% times 1.5 million, right? So 12% times 1.5 million, that gives us 180,000, right? So this is 180,000, right? That's the PMT, 180,000, right? And that's basically the this thing's PMT, right? So this is the PMT of this, and then what's left is just you know that the FV for every loan is 0, right? So you know that the FV for every loan is 0. So I think with this we have enough information to basically calculate the. So with this we have enough information basically to get our present value, right? We have enough information to get our present value. Let me just remove all of this. Okay. So we have enough information to get our present value, right? Where they calculate it here. Do you see? We have I, we have 14. Now you can compute the PV, right? You can calculate the PV. So here's the PV, right? And then so now that we have basically the, now I've removed that thing. So we had those two tables, right? We had the market values there, market values, right? And then here we have our weighting, right? So this is our weighting, right? But I think the memo does also illustrate this. So let's use the memo. So so this is the 31 million, right, that we got, and this is the PV for the long-term loan. So we are done with the market values. Do you see? Then with these market values, like I said, you create this weighting by saying 31 million divided by this, 31,320,000 divided by this, the total, right? Multiplied by 100, then you're gonna get this 96. Then you're gonna say this divided by that, multiplied by 100, you're gonna get this number, right? And then we can now continue to the next part of the table, which is the cost, right? So we want the cost of each, right? So the cost of each source of finance. So we have, so I'm not gonna do the weighting part because I already did the weighting part, the weighted average, I mean. So I'm not gonna do it here. So here we have our ordinary shares, right? Ordinary shares, right? And then here we have our long-term loan, right? We want the cost. So the cost of equity first, right? We want the cost of equity first. So do you see that the information that they gave us, they didn't give us anything here They gave us betas, they gave us risk-free rates. Do you see? But do you see that there's nothing here about growth, right? So we know that for the cost of equity, you're gonna use what? You're gonna use the CAPM formula, right? Because they gave us information relating to CAPM. So to get the cost, so the cost RE is equal to the risk-free rate, right? And what is the risk-free rate in this case? What is the risk-free rate in this case? The risk-free rate, like I said, you are given two government bonds, right? I said take the one of the longest, right? Not in a year's time. So you're gonna take this one, 9.3. The reason why we take long term, right? And if sometimes they won't say this, right? They won't give you this. They will just call it a treasury bill. So between a treasury bill and a government bond, you choose a government bond. Why? Because a treasury bill is shorter. It's shorter term than a long-term bond. So here do you see they gave us two government bonds, right? One short-term, one long-term. So you're gonna take the long-term one because we are dealing with basically permanent financing. And then what beta do we use? Our beta, right? Like I said, beta is our beta, not the industry's beta. Do you see here? They tell us that the retail sector has a beta of 1.4. No, we want to use our beta, right? So we're gonna use the 1.3 for the beta. And then market rate. What is the market rate? They tell us that during the past 4 years, right, the GSE has an average return of 16%. So you're gonna 16% basically the market rate minus what? 9.3, which is the risk-free rate, right? 9.3, which is the risk-free rate. And that, if you compute that in a calculator, it gives us our cost of equity, right? And then the next cost that we have to determine is the cost of liabilities, right? And I said the cost of liabilities, it's simple. Right? So the cost of liabilities, like I say, it's simple as RE, right? We want, firstly, what do we want here from this thing? We want firstly the interest rate, right? So the current interest rate is 14%. All we have to do is say one. So 14% what? 14% 1 minus T, right? And they said here the South African company tax rate is applicable. So minus what? 28%, right? So minus 28%. So we are going to say 14 times 0.72. That gives us 10.08, right? 10.08. That's the cost for this. And then the cost for that, you put that in the calculator, right? And then that's how they got these two answers, right? As you can see here, as you can see here, they use the CAPM. Do you see here? Here they use the CAPM here. Same values that we got. You see the 1.3 for the beta, 1.6 for the risk-free. You see the same formula, and then the loan is 10.8, right? Like I said, it's just the one that's given. Then you have to calculate the after-tax cost of debt, right? And then after determining the after-tax cost of debt, we go back here, right? And then you say that multiplied by that gives us this part, that multiplied by that gives us this part, that plus that gives us the total WACC. So that's how you do that question. Now we've calculated the WACC. And do you see that we follow these steps, right? Because we first determine the permanent source of finance, determine the weighted average, determine the cost of each finance, and then determine the WACC. So please, even if you have to memorize this framework, right? And then go to the next one. So okay, these are just discussion questions. I think you'll see from the memo. You'll answer these ones using the memo, right? Yeah. So that's today's class. I just wanted to illustrate cost of capital, and I hope you guys understand. And yeah, good luck for Friday's test. Before I go, do you guys have any questions? Any questions? Okay. Closing the questions in 5, 4, 3, 2, 1. Okay. Thanks again, guys, and all the best for Friday's test.